Good afternoon and welcome to Key to Options webinar series on credit spreads. Quick disclaimer, Key to Options and Key to Stocks, owned and operated by Capmark Solutions, do not give business, financial, or other professional advice. Material for Key to Options and Key to Stocks are for informational purposes only, meant to help investors educate themselves. No reliance should be placed upon the contents. Key to Options and Key to Stocks do not warrant the accuracy or suitability of any information contained on the website, nor any other links or references to other websites, persons, or information. Key to Options and Key to Stocks accepts no responsibility for any loss, damage, cost, or expense, whether direct or indirect, incurred by you as a result of any error, omissions, or misrepresentations in information on the website. Key to Stocks do not accept liability for errors, omissions in, delays, interruptions to, or cessations to access of the website through negligence or for any other reason whatsoever. And past performance is not an indicator of future results. You may lose more money than you invest in options trading. So good afternoon. My name is Michael McNellis. I'm an options strategist with Key to Options. I've been here coming on a year in October of 2015. Previously, after attending the University of Florida, I began working for J.W. Gant Investment Bankers and received my Series 7 and 63 license. After a short time working for there, I started a mall-based retail chain called Hat Shack. We grew to 49 stores before eventually selling to a publicly traded company called Genesco. I've been trading financial markets for over 20 years, trading equities, options, as well as futures. Ashok Yarlagadda is the founder and CEO of Key to Options. He's a computer science engineer with over 20 years of working in the banking industry. He's worked for companies like Citi, GE Capital, and HSBC as a part at doing the software development for them at Capgemini Financial Services. And during his time there, he developed software solutions for hedging international currency risk, and that's where he found his love of trading. He has over 10 years experience himself in trading equities and options, and he combined his two passions of computer software architecture and options trading to create Key to Options. So Key to Options is a fast, automated options backtesting analysis platform that provides our users quantitative modeling and proprietary state modeling. And so what we want to do is empower you, the traders, by being able to create backtests and do your own homework and your own due diligence. And this will create inner confidence and outer discipline by actually planning the trade and trading the plan. So by creating a quantitative model, we can find out what has worked in the past, and then we will determine when we're going to buy it and sell before we've ever actually done the trade. So at Key to Options, we like to say we make rational trades, not emotional ones. Ashok's idea was that we would create two fundamental beliefs, create simplicity and value. And so the first thing that he wanted to do was we want to create a tool for traders who didn't have access to computer programmers to be able to have their trading signals vetted. So we have a simple, friendly platform that lets traders backtest and create trading strategies without any need of programming, so they can remove the emotion from their trading. And so at the core of Key to Options is it answers the question, what if I had applied investment strategy X during period Y? And of course, we as humans don't have the ability to compute large sets of data like a computer does. So we supply the data and the platform necessary for you to make rational, vetted trades. So this puts you as a retail trader on par with institutional traders. The second thing that Ashok wanted to do was create an indicator that he felt was a no-nonsense indicator, meaning that there's no ambiguity into it. It's either a buy signal or a sell signal. So many times, whether it be the RSI or MACD or whatever it is, it can be subject to some interpretation. And he found when he first started that people would tell him, oh, well, you should buy the RSI when it's above 70, and or sell when it's above 70, and he would do that, and they said, well, it wasn't confirmed on the hourly chart or the daily chart, and so there was some ambiguity and subjectivity to it. So he created what is called our proprietary state modeling, and finding good entry and exit points can be confusing for a new trader because of Bollinger Bands can be and MACD can be subject to interpretation. And state modeling is our buy-sell indicator where we use advanced mathematics to identify price patterns and forecasts that we call time and price projections. And because options trading is more challenging than equity trading, we must not only pick the direction, we must also analyze the amplitude of the move as well as determine the time frame of the move, and state modeling does that. So the other thing, besides our state modeling, as I said, again, we have our quantitative modeling, and the four premises of quantitative modeling are to have a strategy identification, then using that, backtest your theory using historical data. We have historical equity and options data that goes back to 2007. We need to institute risk management. So in our program, you can input your own trading rules that include money management skills. And then finally, an execution platform for your model. So with the Key to Options platform, you can analyze different stocks, indexes, ETFs, create a trading model, backtest it using historical data, and then refine it to find the optimal parameters, and then trade right from our platform through Tradier brokerage. And as a member of Key to Options, all trades that go through Tradier brokerage are commission-free. And at any time, always feel free to contact me. I can be reached at michael@keytooptions.com to discuss the advantages of trading with Tradier. So the second part of the program, besides the quantitative modeling that we allow you to do, is our proprietary state modeling. And again, our state modeling is a mathematical model of computations in which stocks and indices are placed into one of 8 states and is indicated as either bullish or bearish. At any given point in time, a stock can only be in one particular state. So conceptually, if you think about a traffic signal, that would be a good way to think of a finite state machine. Here we can see it's either a red light, a yellow light, or a green light. At no time can it be in 2 states, so you'll never see a traffic signal red and green at the same time. At some point, for instance, excuse me, say the light is green, after a certain amount of time passes, it will change to red, or perhaps a pedestrian comes by, suppresses the crosswalk. At that time, it'll make the light turn to red. So same thing, our program is an end-of-day swing trading product. At the end of the day, our data is, we bring in data, we interpret, put it through our mathematical model, and either keep a stock in the same state or it would transition into another state. Here you can see that we have 8 states. Odd numbers are bullish, states 1, 3, 5, and 7 are bullish states, with state 1 being extremely bullish. Our states 2, 4, 6, 8, or even numbers are bearish, with state 8 being the most extreme bearish. So we see the most moves during a state 1 condition or to the downside during a state 8 condition. So to use state modeling, here we see again 8 different states. 1, 3, 5, 7 are bullish, 2, 4, 6, and 8 are bearish. So if we saw a stock in a state 4, we would automatically know that it's red and it's in a bearish condition. So the important thing in trading for options is we want to know the direction of the underlying. Whether you're a seller of options or a buyer, we certainly would like to know the direction of it. The second thing is the time period. The holding period is critical in options trading. If I think that Microsoft will go up 10% in a short period of time and I select a 30-day option, if it does not make a move till 45 days, then regardless of whether I was correct or not, I won't make any money because I didn't purchase the right option due to time. And the third thing that we do with state modeling is we give you profit zones. So exactly, we give you the direction of the market, the time that we think it will take to get there, and exactly the price that we think it will get to. And I'll show you that in the program. So let's start talking a little bit about options and how we get to credit spreads. So with options trading, we have 2 types of options. We have calls and puts. We buy calls when we expect the market to go up. And when we buy a call, that costs us money and therefore is a debit. So when we're buying a call, it is a debit. If I'm buying a call, somebody has to be selling me the call. If somebody is selling me a call, their expectation is that the market will go down. When I pay for my call option, I have to pay it to somebody and they receive the credit for it. So somebody who is selling a call option is expecting the market to go down and they will receive a credit for it. On the other side is puts. If we are buying a put or we are long a put, we expect the underlying to go down and we will pay for that option. It will be a debit to our account. Again, somebody who would be selling that put is going to think the opposite. They think the market's going to go up, that option will be worthless, and they will receive a credit for selling that option. So again, all options are made up of either buying a call or selling a call, buying a put or selling a put. And depending on the direction that you think the underlying is going, you make the determination of which of those 4 events you will do. So 2 types of options trades, credit or debit. So a debit trade is one in which the option trade creates a debit to your account. So example, like we talked about, a long call. I am paying money for that option. A long put, again, I am paying money for the option. It's going, and also a bull call spread would be an example where we have 2 options joined together, but we end up with a net debit. So it still costs us money. On the other side is the credit trades, which we'll be talking about today. And those are options trades which create a credit to your account. So money in, you'll be the seller of the option, and you'll be selling naked calls. Another example that we'll be talking about today is the bull put spread or the bear call spread. So an option spread. What we're doing when we do an option spread, a credit spread, is we'll be buying an option and selling an option simultaneous. When we do this in option spreads, they can either be, the combination can create either a debit or a credit. Today we'll be talking about the credit spreads. So why do we use spread trading? Spread trading is a great way to control risk. Sellers of options, calls, or puts, if they just sold the option, have unlimited risk. It can be very dangerous if we just sell an option without having a hedge to it. And that's really what we're doing when we're spread trading. We're hedging our risk. And so the seller of an option spread limits that risk and can quantify their risk by selling an option and buying a less expensive option. So let's take a look at the bull put spread. The bull put spread is a credit spread which can be implemented by selling a higher striking in the money put option and buying a lower striking out of the money put option of the same underlying value with the same expiration date. So one thing to look for here is the bull put spread. The bull identifies which direction you expect the market to go to. So what we'll be doing is selling a put and then buying a put that's out of the money as the hedge. We want to take the credit from selling the put, but we don't want to have that unlimited risk. So just in case, we're going to buy one that's further out of the money. So in this case, we would be looking at shorting one February XYZ 45 put, and then we would be buying a XYZ 40 put. So we are short the 45 put and long the 40 put. And that maximum reward would be $275 in this case. And that would be the net premium times 100. So in this case, we took in $2.75. We multiply that times 100, and that would be our maximum reward. Our risk is defined between the difference between the strike prices and the net premium we receive times 100. So in the case of this scenario, it would be the difference between the strikes of 45 and 40, or $5, minus the $275 we brought in for selling the option, times 100, or $225 in risk. So we have defined risk now. We know when we enter this trade, our maximum win is $275, and our maximum risk is $225. So again, in a bull put spread, we expect the market to go up. We want to sell a person a put. We'll take in that credit, and as a hedge against that position, we're going to buy a further out of the money put just to make sure we can define our risk. In case we're incorrect and the market really goes south and takes a big loss, we don't want to have that being the person who has sold the put to take care of that. So we want to make sure we temper that risk by buying an out of the money put. So again, we have defined risk, we know our upside, and we know our downside with the bull put spread. Bull put spread, first word, we expect the market to go up, so we're going to sell the put spread. The next type of spread credit spread would be the bear call spread. So as we indicated, the first word here, bear, indicates that our intention is that we think the market is going to go down. If the market is going to go down, we'll be happy to sell calls because they will expire worthless. So the bear call spread can be created by having a call option at a higher strike price and selling the same with a lower strike price at the same expiration. So we want to sell a call just out of the money and buy one further out of the money. So in this case, we would sell a 35 call and then buy a February 40 call. So we're going to be short the 35 and buy the 40 for our protection. In this case, selling the call will get us $5.10. Our long call, though, will cost us $1.20. So our maximum reward is the $5.10 minus the $120 times 100, or $390. Our maximum risk is the difference between the strike prices minus the net premium times 100. So 40 minus 35 is 5 minus $3.90 times 100 is 110. So now we know our maximum reward and our maximum risk when we're putting on a bear call spread. Again, we could just sell the call outright, but we have undefined risk at that point, and if the stock comes out with, say, a new drug and it goes up 100 points, we would be on the hook for that. With doing a spread, we limit our risk. And so we always want to make sure we have defined risk. And in creating either the bull put spread or the bear call spread, we have defined risk. We know our upside and we know our downside at any given time. So let's take a look at the Key to Options program and see how we can use it to benefit us when we're trading these types of credit spreads. So when I go to the Key to Options program, I'll sign in. Take us to our dashboard. Our dashboard gives us an indication of our state modeling for the major market averages. Here we see the NASDAQ, the Russell, the Dow, and the S&P. Remember, if it's in a green number, it's in a bullish state, and a red number is in a bearish state. So within the Key to Options program, at any time, you can build your own watch list of stocks and indexes that you like to trade, and you can take a look at them on a daily basis very easily. We also give you our market pulse, which tells you the state of the stocks that we cover. Currently, we cover 1,217 issues, and that number is expanding. If you have a certain stock that we don't cover, we can put it in for you. But this helps show you when conditions are oversold or overbought. With our Daily Watch feature, if you go to our predefined, we give you when certain stocks have transitioned into our State 1 category or into our State 1. That's how I like to use it. So if I'm bullish on the market, I want to be buying stocks that are going into their most bullish phase. I can click on this drop down and see that yesterday our program again is at the end of the day. So last night we got this information that these stocks had entered into a State 1 condition. And so UPS, for example, is in a state 1 condition. I can click on it to find out detailed information on it. So here in our state modeling, when you come into our state modeling analysis page, we give you information on UPS. This first box, daily state distribution, shows us how many days UPS has spent in each particular state. The other thing I like to look at next is the probability of next state box. Here it shows our current state is state 1 and that it went in there 1 day ago, and the price that it went in was $1.10. Here we show you our projection in price of 114.01 to 117. So we're expecting UPS to go from 110 to anywhere between 114 and 117. I like to look at the state, find out what state it's in, and then scroll down. With options trading, we talked about the things that are necessary to make a profitable trade. We need to find the direction of the market. We need to find the time frame in which it will move and the amplitude of the move. So a key to options, when UPS is in state 1, it typically spends 41 trading days in our state 1 condition. So that's trading days, not calendar days. To get to the calendar days, we would simply multiply this times 1.4. And so 41 trading days is roughly about 60 calendar days. So we know for the next 2 months, we would expect UPS to be in a positive movement. When UPS is in our state 1, we expect it to go up on average about 6%. So our projection is conservatively 114 and on a more aggressive side 117. But for all stocks and indexes, we give this. So again, UPS, if it were to go into a state 8 condition, we expect it to stay there for 23 days and go down 7%. We can do this for indexes as well. So the SPX. The SPX will find its current state of being in state 2. And when it's in state 2, it's typically there for 9 days, and we expect it to go down by 2%. So now let's take a look at our credit spreads and how we can use that. So I'll show you how quickly I can create a credit spread. The 3 things I'll need are entry exit dates, trade rules, and a group. So I'll create entry exit days. So we'll do a bull put spread, and we'll use our state modeling as the indicator, the reason for buying and selling. So again, our time frame goes back to 2007. If I click on the date range, it automatically populates our entire data set. If I wanted to just run it from, say, 2009 upwards, we can indicate it that way as well. So I'll look for our bullish state 1 condition. We're selling puts, and so we want to be sure the market is going up. So I'll go ahead and copy this name for our entry exit dates, and I'll use the symbol Netflix. I'll hit save and execute, and now the system has found 26 different times when Netflix has gone into our most bullish condition. A great time to be selling puts is when the market is bullish. So now that we've done that, the next thing I need to do is create trade rules. Trade rules is where I'm going to tell the program how much to spend on every trade, and I'm going to give it money management rules, and I'm also going to tell it what expiration to buy as well as what deltas to buy. So we'll give it a name. We can paste our same name. We're doing the bull put spread here. We expect the market to go up. We'll be selling puts. Here is where we tell it how much we want to spend. So I can say I want to spend $1,000. And this is a trend model, and that's for reporting purposes, for display purposes. Then I want to have my money management. Here, I'll say I'm looking for a 50% target on my max profit. We talked about max profit and max loss. Here I'm saying if I have 50% of my maximum profit, because we have a defined risk, I want to close my position. So I'll do the same thing from the loss side. If I take 50% of my maximum profit, if I have a loss of that, I want to close out my position. In option selection, it's going to ask me for the distance. So here, I will put a 5-point distance for my spreads. And because I am a seller of options, I don't want to be out there a very long time. So I'll put anywhere between 1 and 30 days. And what the program will do is look for the next option's expiration. In this case, we're using monthly options. But if you want to use weekly options, you can do that as well. So the next thing it's going to ask me for is the delta. So the delta, we have to decide what we're going to use. So from the selling, we're going to be selling a higher delta, and we'll start with 30 to 38 delta. And the reason we put that is because there's not always a delta at a specific price. So it'll look for a 30 delta. If there's not a 30 delta, it'll go to 31, 32, all the way up to 38. Now, remember we talked about to define our risk, we will buy another option. We'll buy a put option to hedge ourselves. And we'll buy a 10 to say 20 delta option that's out of the money as a hedge. So I'll hit create, and it says my trade rule has been saved successfully. The next thing I want to do is create a group. So our group name is just a way of, like a filing cabinet, in case I ever want to come back and look at it, I can find it again. Again, a trend for reporting purposes, and I'll hit create. So now I can go to my backtest page. I've created everything I needed to run a backtest. I've created entry-exit dates. I've created a trade rule, and I've given my trade rule a group name. And so now I can backtest it. It's run the backtest, and I can view the group. Now, if it comes up in yellow, it means it hasn't completed its run yet. To hit refresh until it's completed. A couple more clicks and we should have it. Okay, so now we've successfully created this run, and it has a profit of $3,333 with a profit factor of 5.87. So the way that we calculate our profit factor is the gains divided by our losses. Anything above a profit factor of 1 is a profitable system. In this particular case, we had an 80% winning percentage. We had 16 winners against 4 losses. 6 trades were rejected, probably because we couldn't find a strike. Our average days in trade were 4 days, and our risk at open was on average 1,296 days. One thing that we show you is efficiency. We show you the maximum run-up. The maximum run-up was $4,000. We captured 76% of that. So if you sold the absolute top every time, you would have captured $4,000. We were able to capture actually $3,333. So a very profitable system. From here, we can break down this trade and look into it in more depth on a per trade basis. So when we click the run, we'll dive into the details of all the different trades. So for example, this particular trade, we can see that we sold a 25 put, Netflix 25 put, on 2/4 with a 2/16 expiration. We sold 2 contracts, and we bought as the hedge 20. And then when we closed out the position, we ended up with a profit of $75. We also show you graphically how where you bought the position and then where you closed out the position. We also show you, we give you the daily P&L of the trade. And here we also show you why you exited the trade. In this condition, a profit target was met. And so if you're happy with that, you could trade this model, or if you want to find out what could have happened if you changed the rules, we simply click on the trade rules, click override, and say, well, let's find out if I was greedy and I wanted 100% of my maximum profit. I'll go with 100%. I'll either take 100% loss or 100% gain. We'll save that. We'll go back to the backtest page and then rerun the same trade plan with the new parameters. We'll view the group. Again, we'll refresh it until it's completed. Now it's completed, and we can see that same amount of wins, but we made a few more dollars. We made actually $1,200 more by waiting and letting that spread expire until we closed out. So we weren't too quick on the to close out the position, and we actually profited more dollars while having the same winning percentage. So we can change this around, and I might want to find out how would it be affected if I change the deltas. So I can change the deltas, and what if I wanted to try to bring in more dollars? I'll override this particular trade plan and change the deltas. Let's see if I got a little greedier and went up to 38 delta minimum to 47. How would that change our outcome? I'll click Save, go back to the backtest page, rerun it, and now view the new results with the change. So it's in yellow, means we have to refresh. And while we're refreshing, we'll see how we did to see if these changes are better or worse. And that's the key to options, is we don't know these things, and we don't have the computing power to know this without a program like this. So here we can say a tremendous difference in the profits that we were able to take in, $6,810, by being more aggressive and selling. Because our proprietary estate modeling is so good with this particular stock, we were able to sell a higher strike price and bring in more money while we did that. And so in this case, the changes have gone from $3,000 to $6,800 just by changing the parameters around. This is not possible without a program like Key to Options. It's quick, it's easy to use. Once you get into the program, learn the dynamics of it, you can see how easy it is to get into a particular plan, find the trade rules, override it, and just answer those questions that you don't know without asking. Maybe I don't want to take that risk of going 100%, and maybe I'm happy with a 20% return. Again, there's no right or wrong answer. It's what you're happy with. And so what happens if at 20% every time I took off this trade, we simply test it, and we can find out all these answers. If you're buying calls, what calls are you buying? How do you know you're buying the right ones to make the most money? Now we can answer these questions by going back in time and testing them. So remember, once you run a model and you need to wait until the yellow bar is removed, we just hit the refresh button. And you can find out what the actual outcome is. Now, if you haven't already done so, you can go to our Key to Options website. Here, you can download a free trial. You can get a free trial, you can get a demo, or you can get a free trial and a demo where I'll walk you through the system. If you have a particular trading strategy that you're using, we can figure it out. I can show you how to set it up, and you can go back in time and test and find what are the best options for you to be buying or selling. So whether you're using iron condors, butterflies, doing straddles during earnings period, simply trying to covered call writing, any of those strategies are available through the Key to Options platform. If you would like to become a member, you can click on Become a Member on our website, and it'll show you the pricing. For our annual members, for Options Pro gives you all the options trading strategies as well as equities trading, and free commissions through Tradier Brokerage for $125 per month. Stocks Pro would be $50 a month. There's no sign-up fee for annual members. Or if you choose to do a monthly subscription, it's a little bit more expensive, and there's a $199 fee. Again, commission-free trading for stock and options as a member of Options Pro. And if you're a member of Stocks Pro, it would be equities only trading, would be commission free. So Love to see you come and become a member of the Free to Options, of Key to Options, and have free, commission-free trading. So with that, I'd like to thank you all for joining our Key to Options webinar on credit spreads. This webinar has been recorded and will be up on our YouTube channel, Key to Options at YouTube, later today. And if you have any questions about Key to Options, please email me at michael@keytooptions.com, or you can always reach us at 813-330-0900. Thank you and have a great day.